Financial Action Task Force, the global standard setting body. And in an interview late last year, he said, I would sum up the results as everyone is doing badly, but some are doing less badly than others. And what he was referring to was actually at the country level. He was referring to the results of the FATF's ongoing round of assessments. Since 2014, the FATF has been assessing all of its member countries. So far, it has done over 100. And the results are uniformly poor, in the sense that the implementation of the Financial Action Task Force standards is not up to scratch. And this goes for large jurisdictions, small jurisdictions, jurisdictions within the EU, even what are relatively jurisdictions that have relatively high scores, such as, for example, the US, are nowhere near the top marks. So no jurisdiction in the world, in fact, it has yet scored high marks when it comes to the Financial Action Task Force actual benchmarks that they are asking their member countries to meet. But this could also apply to businesses. There's been a number of events and webinars recently where the Financial Action Task Force leadership are clearly on a bit of a campaign, if you will, to position and to try and drive change throughout the industry. And the way that they're doing this is that this year alone, they have been to over half a dozen large-scale industry events online to push this message that we are seeing on the screen, that they are not satisfied with progress in the last years. They expect and they want to see more from industry and from national authorities. So we'll take a bit of a closer look at what is behind this statement. And perhaps the one way to look at it is that what we're seeing is a large gap between the efforts and the investment that is being put into place by governments and banks across the world and the actual outcomes that are being achieved. So what we are seeing is that there's the well-known statistic of how much banks are investing in compliance on the aggregate, which runs into hundreds of billions of dollars a year at the lowest estimate available. So of course, there's the investment in compliance, there's investment in training, and there is the investment in also enforcement on the public sector side. There's also, as we'll see in a few minutes, progress on legislation at the EU level, in countries around the world, also in the US, some really remarkable evolution that we're seeing in terms of legislation. But this is not translating into actual progress in terms of outcomes being achieved, financial crime actually being reduced, stopped, prevented. And what we're also seeing is that fines continue to grow and sanctions continue to grow. So almost every week there is an announcement from some jurisdiction that yet another bank has been found wanting in its compliance systems and has been fined. And yet, despite this increasing pressure, we continue to see a lag in terms of actual outcomes being achieved. And what we see on the slide are two first ideas on why this might be the case. The first is that the exposure to financial crime risk that large banks are having, particularly in the US and the EU, is increasingly through their relationships, their cross-border relationships. In other words, they are not usually, in recent months at least, being fined primarily for failings in their home base, in their home country, in their home jurisdiction. What they are seeing is that there are gaps in how they are dealing with risks in other jurisdictions around the world. The other area where we see that there is a gap is when it comes to metrics. There is a growing and perhaps unanimous even consensus in the industry at the moment that without metrics to actually define what it is we're trying to achieve and to be able to set targets and to be able to measure progress, it is very hard to actually see whether those outcomes are being achieved. So these two gaps in terms of relationships being an entry point to risk for the industry and the lack of metrics in order to define and measure progress are perhaps two of the biggest gaps that explain why, despite the investment in compliance and the progress in legislation, outcomes are not yet being achieved, and there's this increasing pressure from the top, if you will, from the Financial Action Task Force and from bodies in the EU and the US in particular to see progress. But this is perhaps a summary of the picture that they are seeing. So we thought we'd take a bit of a closer look at what is happening in the EU. And one of the big developments in the recent years, of course, has been Brexit, which actually was finally came to pass on the 31st of December last year. But this has also had an impact for the financial sector, of course, where increasingly the sense of gravity is shifting away from the UK. So clearing relationships, for example, are increasingly shifting to other jurisdictions, in particular the larger ones such as Germany, where we are based. We are based in Berlin. And this has meant, in turn, increased pressure on national authorities in the EU to actually take action, and there is increased pressure on them from the media also to actually make sure that anti-money laundering measures are in place, both at the national authority level, but also at the business level. We'll talk in a moment about a couple of the specific points of the 6th Anti-Money Laundering Directive, which was just which should have been transposed by the 6th of December last year. We'll see in a moment if we'll talk more about that in a moment to see if that has actually been the case. But there's this increased pressure on national authorities to actually raise the bar and increase their standards when it comes to stopping anti-money laundering. And one of the signals for this, of where we're seeing this increased pressure and this increased intent to deal with anti-money laundering, is that any moment now, the next legislative authority, which some sources say may include also an enforcement aspect for this EU-wide anti-money laundering authority. So we thought we'd give just a couple of ideas of the pressure, the new pressures that financial institutions are under when it comes to anti-money laundering here in the EU. So the 6th Anti-Money Laundering Directive, which should have been implemented in December last year, and where throughout this year the European Commission will be assessing to what extent it has been implemented by national authorities and by businesses. So we don't yet know to what extent it has been actually put into place. It includes a number of really remarkable shifts. Sometimes people think because it's a 6th directive, it's just a small add-on to the previous 5, starting with the first in 1991. In fact, it's really true to say that the 6th Anti-Money Laundering Directive is a big shift in terms of the EU's intent and investment in dealing with money laundering as a problem. This is, of course, partly driven by large scandals, such as the one in Denmark a few years back, that really affected the image of the industry in the whole of the EU. And not just that one, there's also been some recent scandals in Germany, putting pressure also on German authorities to also up their game, for example. But just to give some examples, a flavor of what banks are having to comply with now in the EU that they did not have so much clear pressure on to do so before. The new directive is defining a standard list of what they call predicate offenses for anti-money laundering, which previously was left to each national authority, but now has actually established a list of 22 offenses that the European authorities expect authorities in member states to actually transpose or translate into their national legislation. They have also increased the penalties for failures of money laundering. So the minimum has been raised from 1 to 4 years. In addition, for not only individuals inside companies can be held liable for anti-money laundering failings, but the entity itself can be held liable. In other words, assets can be frozen, licenses can be removed. So the European authorities are asking national authorities to also take action when it comes to the legal entity level. And one big change there is that the act of omission, so not stopping money laundering from happening. In other words, it doesn't have to be actively committing a crime, but just enabling it to happen, is also now recognized as a potentially criminal failing in the anti-money laundering directive. So as a result of this, banks in the EU are increasingly under pressure to revise their governance, to make sure that they have decision-making processes in place at the highest level, to make sure that their systems are ready for these changes. And they are under pressure to make sure that their people, their training, their onboarding, their recruiting are up to scratch, to make sure that they have the systems in place both in terms of policy, technology, and also people to deal with these changes that are coming down the pipeline for them very, very fast. Now, just perhaps a word on correspondent banking before going to the US and passing on to Shane, which is that interestingly enough, and thankfully, the EU continues to have a risk-based approach to correspondent banking. In other words, they are not necessarily asking banks to have extra due diligence or to take extra measures when it comes to non-EU banking relationships. They are saying that they may be needed, but what they say is that they do not prejudge if a correspondent banking relationship is high risk. And this is, of course, very important because it opens at the national level and also the business level for players outside the EU. It provides an opportunity to actually demonstrate and show progress and actually move away from a tick-the-box approach that has really led to increased costs and not so much effectiveness, as we were saying before. So I think with that, we'll pause perhaps the EU and shift across the Atlantic and to Shane, who will talk about the US and some next steps.
Cheers. Thanks very much, Max. You know, the one thing I would just add on the EU side is I think we cannot understate the significance of or excuse me, we cannot overstate the significance of the pressure that regulators in Europe are feeling right now. You know, there's been several very high-profile scandals in continental Europe over the last couple of years that have forced the regulators, in particularly the BaFin here in Germany, which is where a lot of the euro transactions are now being cleared, to undertake a period of very extensive self-reflection. You know, as people may have heard, the BaFin fired their previous head and hired a new head. For a German regulator to hire an Englishman to run the entity is a real indictment of the local culture of enforcement. And so what we anticipate to happen, and I recently heard a talk by the Deputy Secretary of Finance here in Germany, where the new head of BaFin is coming in with a very strong mandate to drive enforcement and to create change in the market. That will inevitably have a knock-on impact to those banks who are being serviced by banks situated in Germany, not just German banks, of course. What that's going to look like exactly, I don't think we know, and that's part of the problem. We know that things will change, but we don't exactly know what they will change to. And I think that that's also reflected when we turn our attention to the United States. So one thing I would note, just on an administrative note, if folks want to, Zoom doesn't really lend itself to speaking up to ask questions, but feel free to use the chat function or the hand raising function if you would like to highlight a question or raise a point for discussion at any time. So moving on to the US, as people might have heard, in December of 2020, the US Congress passed a new Anti-Money Laundering Act. And this represents the most significant change in what they call AML/BSA policy since the Patriot Act, which came about in 2001. There's also, as people may have heard, there's been some political changes in America, and that's having an impact as well. So let's take both of those 2 points in turn and try to digest what that means for banks who are clearing US dollar transactions, engaging directly with US banks, or engaging with US banks via intermediaries. So starting with the political dynamics in America. With the introduction of the Biden administration, the feedback that we've gotten from both the Banking Committee in the US Senate, as well as the Financial Services Committee in the US House, is that there will be an increased focus on driving standards across banks, and a much stronger focus on foreign correspondent banking, as they call it, than was the case during the Trump years and during the years when the Republicans were controlling the Senate. So many of you, if you've been in banking long enough, you'll remember kind of back when there was a senator called Carl Levin who ran the Banking Committee in the Senate. And he was sort of responsible for HSBC's investigation, and if we go all the way back to Riggs Bank and others. And during that period, I think the globe felt the pressure imposed by the US very directly, not indirectly through the banks, but very directly. The sort of shifting between the policy and politics here, the new AMLA actually provides a legal and statutory framework for implementing that. So we expect, our expectation is that the US forcefulness around sort of extra-jurisdictional enforcement will increase dramatically over the next 4 years. Assuming that the Democrats retain control in 2022, we anticipate that this political pressure will be retained until at least 2024. There are certain voices in the US Congress which are very strongly pushing for stronger enforcement. Voices which have been there for some time, but are now gaining much more robust platforms. So folks like Elizabeth Warren and Sherrod Brown, who will not be the least bit hesitant about calling the likes of Jamie Dimon or Jane Fraser into congressional committees and grilling them, which will have an impact on all of us. So moving on to I always think of politics as being a little bit abstract in a way that I don't really like. Whereas the Anti-Money Laundering Act is very specific in how it's going to impact the non-US banks. And I think the short answer to that is it's not going to make life easier. There's a couple of steps which were taken in the Anti-Money Laundering Act, which I think are notable to discuss. The first, and people may have heard about this, is that now the Department of Justice has explicit authority to issue subpoenas to non-US banks who are transacting in the United States. Previously, this wasn't the case. So if previously, if FinCEN or the Treasury or the DOJ wanted to try to gain information on transactions which had passed through the United States, for example, they would subpoena those records through the US bank. And you would very likely not have heard about that if it happened to a transaction which involved you. So they would send that to Wells Fargo or to Citigroup or whoever, and then those banks would provide those records, but they would do so with a fairly limited amount of data because they would only have let's say the SWIFT payments, or if they had done an investigation, the results of their investigation. Under this new allowance created by the Anti-Money Laundering Act, however, the Justice Department can send that subpoena directly to you if you transact through Citigroup or Wells Fargo. Now, one could ignore it, I suppose, but an organization ignores the Department of Justice at their peril, I expect. What that means, though, is that they're going to be asking for much more data, much more information than has historically been the case. And that's going to create a jurisdictional conflict. It could potentially create a conflict of law around your ability to disclose that information to foreign authorities. So we don't know whether or not the Department of Justice or the Treasury will actually exercise that power. It's not exactly straightforward or simple for them to do so. It would be quite complicated, but they are able to do so, and it's not unreasonable to think that they will. The other point is that when they issue these inquiries or these subpoenas, in my experience, having seen some of these issued to the U.S. banks for which I was previously employed, they wouldn't necessarily. It's not the same as, let's say, a request for information coming from a correspondent bank. It's not that they would say, we want to understand the source of wealth, or we want to understand the line of business or something like that. They tend to be fairly expansive in nature. And so they would essentially say, look, you tell us everything you know, and we'll decide what we need and what we don't need, which is a much more significant request than an RFI would be. So, these points taken together, i.e. much stronger political pressure, a desire to change international practices as well as those of US banks, stronger regulatory pressure on American banks, which is going to continue to change their calculus. All of that for non-US banks creates quite a lot of uncertainty. We don't know how intensely they'll enforce these new capabilities. And so the prudent organization needs to, whilst not overreacting, be prepared for what that might entail. A few other points that I would note just in terms of priorities that we hear coming out of the US. I think we saw this with some of the laundromat investigations. We saw this with 1MBD, but the Justice Department has been quite expansive in their investigative mandate to look at markets where they think where they think there is some sort of a systemic issue, where they see corruption, where they see political misconduct, and I think that we could probably, without being excessively cynical, say that those enforcement actions haven't necessarily been equally kind of utilized across markets, right? They're utilized with a certain amount of political selectiveness. Which again, we don't know where that focus will lie. So all of that, I think, is to say that things are not going to get easier for clearing US dollar payments. We anticipate that between the FinCEN files and the changes in US political and policy circumstances, it is not unreasonable to think that we will see some of the same dynamics in terms of contraction around correspondent banking relationships, retrenchment into a smaller number of more profitable relationships by the US dollar clearing banks, similar to what we saw in 2012 or 2010. I think this will have a knock-on impact of probably creating more non-US intermediaries. So non-US banks who are nesting payments or clearing through downstream payments which is a completely pragmatic way for the market to respond, but operationally extremely uncertain for banks who are using those services. Okay, so moving on from there, I think the next question is kind of, what does all this mean for us? And I'll start with just a high level overview of, for us, how we see the market changing. And the market is changing. The deployment of technology solutions, the consolidation that we've seen in the market, all of this is coming together to constitute a significant shift in how the correspondent banking market works. We continue to see within the US contrasting priorities within different institutions, with the Treasury Department taking in particularly the OCC, the regulator there, undertaking actions which are driving some of the points that we mentioned earlier in terms of consolidation, and the Fed having a different view. To date, the OCC and the Treasury have won in that argument, and the Fed has not. There's no reason to believe that will change, and so we don't expect to see a change in the way the market is shifting. So what does this mean? In our view, there needs to be a reduction in friction in the market, and there needs to be a certain amount of standardized information sharing and standardization across assessment. So the way we like to look at the financial crime risk market today is where credit was 100 years ago. Bilateral navigation of relationships, bespoke or subjective criteria for managing that risk. That was about the time that John Moody's came in and introduced standardized credit rating assessments. And our view is that something similar is going to emerge. Whether it's one or two or three different parties, whether it's driven by regulators or it's private sector driven, we are going to see the kind of emergence of a centralized network for that kind of benchmarking. Part of that is going to be standardization of metrics. So many of you will today do a kind of a Patriot Act certification in order to have your US dollar clearing accounts. The discussions that we've had where we talked with US policymakers is essentially around the idea that the Patriot Act certification has run its course. Its usefulness is more limited, and it needs to be replaced by something that is more validated and substantiated. And that in our view, will sort of be, that Patriot Act certification will be enriched or displaced by the emergence of standardized metrics, in the same way that it has happened in credit. That we will over time see the emergence of clear scores. We'll understand what those scores mean. The market will begin to take a view on, let's call it prime versus subprime money, financial crime risk. All of this is going to happen, in our view, in the broader context of integration into the ESG dialogue. So certainly, ESG is in the US and in Europe sort of taking over in some respects the macro level due diligence thinking. How counterparties are viewed is being contextualized increasingly in the ESG framework. And we see that extending on. But again, that kind of framework is going to require those standardized metrics, which were mentioned earlier. And we also think that the ESG frameworks tend to rely heavily on those centralized networks for benchmarking. And then finally, and I think this is something that we can either look forward to, prepare for, or just loathe the day that it comes, is a move towards pricing of financial crime risk. And we anticipate seeing this through a couple of different ways. One is going to be in correspondent banking, for sure. So we've already, had banks who are approaching us to talk about this. We know that there are multiple initiatives across the market to utilize some of those metrics and benchmarks to determine what is the pricing or what kind of rebates are going to be offered, et cetera, in the correspondent banking context. On the public sector side, however, we see additional applications where, for example, in Europe, there's increasing focus on the use of financial crime risk as a measure for capital requirements or capital allocation, how much capital is required in order to manage risk. And likewise, we see the emergence of financial crime risk derivatives as being an inevitable byproduct of that. This is just a kind of our view of what the future looks like, based on what we're seeing from both a policy perspective as well as what we're hearing from the large global correspondent banks, so the JPs, the Citis, the Standard Chartered. So that's good to know. It's nice to understand, but what does that actually mean for you as a financial institution, trying to maintain operational stability, to service your clients, and ensure that you don't have disruption when somebody wants to undertake a trade transaction or send some money abroad. The first point that I would highlight here is it is increasingly viewed as the responsibility of the originating bank, if I can kind of use that term, or the respondent bank, if you want to say that in correspondent banking. The bank takes proactive responsibility for depiction of its own risk. Put another way, you need to do due diligence on yourself. It's a bit of a strange contrast if we think about this in the credit context, right? So if you're going to another bank abroad and you want a line of financing for some reason, you're going to go to them with all of the documentation and audited financials and everything that's required in order to build confidence and to ensure that they understand your risk profile. And that makes sense. We're accustomed to that. We wouldn't ever think to not do that. And that goes down to, if you personally go to get a mortgage, it would be the same. However, on the financial crime side, we switch that burden, and it doesn't make sense that we would. So we go to our foreign counterparties and we say, what do you think my risk is? And what we see when we look across financial institutions or networks is that we often find that the risk that the correspondent has assessed is very different than the risk the respondent has assessed for themselves. So they don't view the risks the same at all. The correspondent is making those decisions on the basis of a pretty limited data set in many instances. So they're only able to look at the transactions they see and perhaps what's in the public domain or what's in a Wolfsburg due diligence questionnaire, which is not a lot of information. Even though it's more than it used to be, it's still not a lot. A more sustainable way to take this forward is, and what we see increasingly as the expectation, is that banks are going to their counterparties and saying, we've done a credible, independent assessment of our own risk, We've included all available data set to do that. We've looked at our transactions, we've looked at our customers, we've looked at our control framework and how effective it is. And here are the results of that. And then the question is, do you like that or do you not, right? Is that within your risk appetite or is it not within your risk appetite? One of the points I didn't mention earlier from the US that we're seeing is the emergence of this requirement for what HSBC calls perpetual KYC. What we prefer to call it continual KYC. But this idea that the US banks are being pressured by their regulators to perform KYC on an ongoing basis. That it's not that they review their KYC files every 2 years or 1 year, but rather that they're using all available data sets to do so every week, every month. So imagine, the burden that you face when your correspondents are asking you to undertake their due diligence process. Imagine that times 12 or times 24. As we try to implement this as they struggle to implement continuous KYC and to satisfy their regulators. In that situation, the only way that you will find time to do anything but KYC is if you are presenting them proactively with an assessment of risk that allows them to defend themselves and to defend maintaining that relationship. So that's step number one. We can talk a bit about how that can work. There's a lot of different ways you can do that. Our preference is to do it through automation, but certainly there are other ways. But it is that is a requirement that is coming, and that we can say with a high degree of certainty. The second point is around collective action within markets. So I was recently having a discussion with the head of FIG for Citigroup in Africa about a market in Africa that they were looking at. And one of the banks in that market was kind of the biggest bank, a strong performer and so forth. And they wanted to get Citigroup to engage with them directly. And Citi's view was, it's not worth doing until the entire market has a certain degree of integrity or confidence, that there's a certain degree of confidence across the market. So what this means is that in reality, if one bad apple sort of taints everything, both the public sector and the private sector financial institutions need to be working together in a market in order to ensure that number one, the market is not systemically exposed, but also to maintain exposure, or to maintain connectivity, to international financial institutions. And then the third point from our perspective is actually to ease some of the friction and work more closely together across those international networks. So if as we anticipate, US dollar clearers continue to rely on aggregating banks and intermediaries to support commercial requirements in smaller markets, for example, it will become extremely important for us to create a mechanism whereby three banks, the US bank, the non-US bank, and the Azeri bank, are all able to communicate clearly and maintain consistency in their risk judgments. The consequence of not doing that is that the US dollar banks will take action unilaterally. And because you're one step removed from them, it's very, very difficult to change that. So one way that we facilitate this, for example, is that in a nesting scenario, we enable so when we work with a bank who is nesting, we enable that bank to send a due diligence packet, either one time or on an ongoing basis, directly to the US dollar clearer, even if they don't have a contractual relationship with them. That ensures that the US dollar clearer is able to defend the decision to continue processing those transactions, were they questioned by their regulator. And this is exactly the problem, and this is what happens, is that an OCC examination team will come in and sit down with the FIG team and Citigroup, and they'll say, why did you clear a payment for, I don't know, let's say, that Tajik mining company? And they won't have a good answer to that question, and they'll say, sorry about that, we won't do it again. And what that means is that the Tajik bank will just get cut off. The only way to avoid that is that the US dollar clearing bank can say, look, here's what we know about the Tajik bank. The Tajik bank focuses on mining. They've had that line of business for 25 years. They're comfortable with it. We've seen that same kind of transaction every month. That sort of defense comes through proactive due diligence. It doesn't work if we rely on the old kind of RFI approach. I hope all of that makes sense. Just to really briefly expand out on this idea, regardless of who the party is that you are managing from a risk perspective. So whether you're trying to ensure that your regulator has transparency, or your clearer, or their clearer, or their clearer's regulator has sufficient transparency, all of this really comes down to what we refer to as proactive risk management. That is to say that you are driving that narrative. You are telling what your risk profile is. That model is credible. It's not self-serving. It's, we've often seen sort of the correspondence between institutions where the bank sends a risk assessment to their correspondent, and there's a heat map, associated with it, and the whole heat map is green. It lacks credibility. No one has a green heat map. Citigroup doesn't have a green heat map for sure, as the Fed will tell you when they fine them $400 million. This also allows for a different kind of discussion, and I would say an easier discussion with foreign correspondents and counterparties, where we're talking about targets, clear numerical targets, or clearly defined targets. What do you want us to do? We want you to reach this threshold. We want you to demonstrate this process in a way that, again, is defensible. And when those requests do come in, that you've got something there that is credible, again, that can be used to respond to those. What our experience has been, the banks who deploy this proactive risk management approach, there's some work involved in it. I'm not going to lie. Doing a robust risk assessment, a robust, honest, credible risk assessment that utilizes a broad range of data, that is not an easy exercise. However, the set against the amount of time and effort that is spent to manage requests for information, to manage ongoing due diligence requests with 15 different correspondents, to manage the needs of the business when they're out trying to gain new counterparty relationships. It actually makes life a lot easier. I think our banks usually, the banks we work with, have found that deployment of proactive risk management improves the credibility and confidence within the counterparty relationship, and enables the bank to grow, if I can say it that way, with much less friction. I'll just you know what our view, if there's kind of one takeaway from our perspective, it's really that as going forward, or as we look to the future, the market is going to reward banks who show that they understand their risk, they have a plan to manage their risk, and they have the capability to execute on that plan. Building that kind of counterparty confidence is going to reduce friction. Failing to build that counterparty confidence means that we will continue to have tactical communication between banks. We will continue to have de-risking, and costs will increase as a result of that. Are there? I'll pause here for a bit because Max and I have been talking for a really long time. Are there questions around this, or any points that the group would like to focus on? Okay. I mean, I know that like I said, these settings don't really lend themselves to asking questions. Max and I will circulate these materials subsequent to the meeting. Please feel free to reach out to us anytime if you want to ask specific questions. We really welcome that. With that, then I will I'll go ahead and turn over to our colleagues over at Raiffeisen. And Eliza, do you want to kick off, or?
Yes, sure. Thank
you.
You.
And I'll go ahead and I'll share your deck unless you would like to, Eliza.
Yeah, thank you, Shane. Thank you, Max. Hi, dear colleagues. Good afternoon to all the dear colleagues in Baku. Some of you may know me. To those of you to whom I'm not yet known, my name is Eliza Kavrakova. I'm heading the institutional clients team for Eastern European region at RBI, and I have with me on board today my senior team member Pavel Zarutsky. Pavel is in charge for the relationship with all Azeri banks and our Azeri correspondents, as well as Irina Lorenz. Irina is our institutional clients due diligence expert. However, when I say due diligence, it doesn't mean that Irina sits with compliance. Not at all. She's with us on the business side, and I think this is one of the signs how important compliance tech is to the business, and because we've started seeing compliance as an enabler for doing business. Frankly, I wouldn't have believed a couple of years ago that I'm going to tell this as a very business-driven person, but that's a fact. Thank you also to the Azeri Banking Association, and particularly to Elucidate as well, for giving us the chance to join this online event. Because this gives the unique opportunity to share with you some insights from our kind of micro or particular perspective of a Western correspondence. And to be very frank with you, one of the few who are, kept staying in the market and still continue supporting Azeri banks in respect of international clearing services. And I can, on the one hand side, I fully subscribe to what Max and Shane said so far. I'd just like to give some additional color to that from our particular perspective. If you allow me, I would share my view on the challenges you very concretely face right now. So first, the most of you have very few or only one Western correspondent banking provider. Secondly, I'm also very well aware that to diversify your nostro relations to other Western banks, particularly in US dollar, is currently more or less mission impossible. And if someone wants to correct me, be my guest. Thirdly, I think you feel being put under extreme scrutiny and monitoring, which maybe looks unjustified, despite the fact that you guys fulfill all what your local regulator requires. And fourth, you may think that only Azerbaijan bears currently this burden on its shoulders, and there is no one else on planet affected by what's going on outside. Now, let me tell you, first of all, you're not alone, because all the global trends which Shane and Max were referring to, they're not affecting solely Azerbaijan, but also us, being here, or to many of you, a Western correspondent. Further, I remember of kept repeating this to many of you in the recent years. Regretfully, it's not enough to tick solely the local box. It is a fact that if you're internationally active and need international clearing services, you need to thoroughly consider, and this has been mentioned partially already, you need to consider the requirements your correspondents have and which are based on regulatory requirements on their own regulators. So despite the fact that formally you're obliged to follow what Central Bank of Azerbaijan is giving you as regulatory standards, I'm afraid it's inevitable to include into your internal policies, processes, and structured standards which we as well ask you, as your correspondent ask you to consider. So de facto, you're put in a situation to literally pioneer and be ahead of what is purely, purely locally required. The scrutiny which we see has massively increased. I can only confirm that. The patterns which other Western banks, also our own clearers and ourselves, so the patterns we are checking, they get more complex. It really goes into kind of forensic work. So it's not only like checking the single payment flows of a single bank, but it goes beyond like matching the payment flows with, for example, trade flows of the country. The KYC is enlarged by starting from vast adverse media checks, permanent coherency checks, etc. So to say that this is exaggerating and to ask why you should do that, I think you may give yourself the response after all, particularly what Shane has referred to in his slides. I think it is essential to, if you wish to keep your relations, if you wish to enlarge your correspondent network, it's in my view very, very essential, and I can confirm and relay this to you: the transparent, the regular, the proactive updates to your correspondence. This is particularly referring to the last words of Shane. It's essential, in my view, to understand that compliance is not solely an issue for compliance department. It should be an understanding, a profound understanding throughout the hierarchy structure of a bank. And yes, you need to allocate the time, the efforts, the resources, and the attention to the topic of compliance. And apparently, there are, there is a majority and very good external tools to support compliance excellency. Elucidate is a bright example of that. So again, compliance should not be solely the issue of compliance department. So additionally to what I've said, I will give now the floor to Irina, who is even the bigger specialist than me, to give a bit more color on and insights on what a correspondent like us expects and how particularly this can be achieved. If you have any questions, of course, I'm happy if you post them in the chat and we'll respond. Ira, your floor.
Thank you. Hello, everybody from my side. So as many points were already made, very great points on why compliance topics are so important, I will not stop or waste too much time on the first bucket in the slide that you are all seeing right now, on the why I think enough has been said. We see the pressure. We know that this pressure is not going anywhere. So we as an can you please stay in the slide? That's great, because we will go right into the insights as to what we as a Raiffeisen Bank, the one acting on a European stage, but also active internationally. So this is the view that we have currently, what we understand under the AML awareness, and this is something that I would like to give to you as insights, ideas, inspiration, or maybe just some food for thought, to enhance our cooperation. As I was very glad also to see that many of our esteemed counterparts were present in this call. So I think it's great that we talk about it in such a big round. So first point that I would like to discuss is the timely reaction. I think we all have seen, especially in the beginning of this year, in Azerbaijan, that how important it is to react quickly to the market trends. I would maybe go ahead and say that we've seen a little bit of a delayed reaction on many players in terms of the USD clearing topic, for example. So how do we stay proactive? How do we stay quick in our actions? I mean, I think it's very important to have a clear strategy in terms of compliance development. So as a credit institution, how do I react quickly? I, of course, need to have established policies, established organizational setup also to be able to react quickly. So this is one idea that I would like to leave with you. Like maybe some of you know, what we did is that we have implemented a very clear framework which dictates what markets, what products, what counterparts are our targets, and what segments of customers, or maybe what countries we need to pay close attention to in terms of risk. So this is the strategy that that I'm talking about here. To have a clear framework, clear limitations of where we move within our business decisions and our compliance decisions. So what is important from our experience with establishing those frameworks or those strategies, it should be a collaborative exercise. As Elica also mentioned, it needs to be understood, it needs to be accepted on various levels in organization and on various levels of defense as well. So when we, for example, started to implement the clear set of rules, it was a collaborative exercise where the driving force is not only compliance, but also the business and the product departments and everything who needs to not only create a certain document and forget about it, put it in the shelf and continue as we were, but to actually live by this new set of rules, this new mindset of being compliant and being aware of the risks that we're all facing. So this is the first point. The second point would be we need to manage the compliance risk in a good way. So not only to define the rule, but also to live by it, as I said. And what is here also important to mention is that, yes, we are credit institutions and we are following the letter of the law because we have to, this is clear. But maybe in some instances, we can think a little bit broader than just what the law prescribes or just what the local law prescribes, but think a little bit about our risk appetite, for example. Yes, there is a must, according to the legislation, to do certain due diligence processes, but maybe we would like to take a step further and do a little bit more, to show to our regulators or to our partners that we are proactive. We take a step further. We want to define our own rules of the game. And what I mean by that, and maybe another example again from our experience, what we have been doing is that we have been implementing filters, for example, for the onboarding process. So before accepting a new client relationship, we have been establishing more and more filters on the way to really check, is it the business relationship that will help us achieve our business strategies, achieve our business goals, but also achieve our compliance strategies. Because as Elisa mentioned, yes, this is not always the easy task to find the balance between the two. But I think with a clear set of rules and the clear strategies, for example, a customer acceptance strategy, this could be a step in this direction of stepping away from just following the rules into the more proactive and clear strategy of dealing with the risks. So this is.
I think, Ira, maybe to just to add here for even better understanding, or to put it like into perspective. For an onboarding decision where we're really checking everything from A to Z, as Ira is mentioning, and filters, etc. Ultimately, it's just understanding how much am I gonna earn out of a relationship against how big is the danger to be penalized. Yeah. And if I understand that the counterpart is profoundly prepared, knows, as Shane mentioned, its own risk, and presents this in a convincing way to me, so that I'm, I really feel comfortable that I have as a counterpart someone who is, again, not formally ticking the boxes, but has made its own homework, then the decision is much more comfortable to be, to have a positive outcome. Because again, it's always, particularly for the top decision makers, it's the issue, how much do I benefit from a relationship against how much am I gonna pay if my regulator knocks on my door? That's kind of an ultimate sentence which we have in our, in our mind.
That's very true. The other thing is once the framework, what we were discussing, once the framework has been set and we know what areas, what products, what customer segments we would like to focus on, now it goes deeper into material assessment of every single client. And yes, this will vary depending on the customer base. So we as a credit institution, we have a strong focus on corporate customers and institutional clients. For us, it's a real deep dive into every customer. And with a deep dive, I'm not only meaning the KYC or KYCC, even this is already old news, but really having the material understanding, also taking into account reputational risks, maybe something that maybe doesn't happen right now in this particular customer segment, but might happen in the future because we see certain developments, or the auditor checks or regulator checks show us certain signs of shifted focus in the checks. So this is what we when we talk about portfolio review, this is what we're talking about, really stepping away from the formal view, although formality is also very important and very much sought after, but still also taking a step further and doing the material check and understanding. And only this material check and this needs to be also done on the continuous basis. I think this is a key word that I'm gonna return to in a few minutes. This portfolio review and these checks will allow you to define the dedicated, identify the dedicated risk areas, and make sure that you take action to mitigate those risks or to avoid certain events that might jeopardize the business cooperation or the business development plans, right? So maybe now, conscious of time, very quickly on the how, like really couple of words from our side. As we mentioned, what we see as a critical point, a crucial point, is that AML awareness is not only something that exists; it's also something that needs to be documented, and we need all to have a proof for our regulator when they come. We need to show what we did, what we are doing, what we are planning, right? So maybe this word proof is something that I would like to stress right now when we are discussing about how we can increase our AML or compliance in general awareness. So here, what we found from our experience is that diversifying the tools that are at our disposal, that we're using to define the framework and then to assess the client portfolio and to keep it continuous, like to monitor continuously what has been going on, because only if monitoring is done continuously, we catch the red flags in time and we can react upon them appropriately or timely. So diversifying the tools would be really a huge advantage here. And also not only diversifying, but also using third-party providers. So we know we have...
Теперь просто нам надо у кого это выяснить. Нам нужно это выяснить. Merdi, mana yusfaz diyecek.
Excuse me. I think it's not a question. So if not, please mute yourself. Thanks. Okay. So not only diversifying, but also using third-party providers, because we're all working in a bank. We know time constraints, budget constraints. This is the big old issue. So there is only so much we can do in-house. So yeah, we have been cooperating with many external third-party providers in terms of adverse media screening, in terms of client assessments, transaction monitoring, and we do encourage our partners, our esteemed banks that we work with, to do the same. So if there are any questions, please feel free to post them in the chat. Thank you so much.
Thanks, Irina. So if we do, Pavel, sorry, would you anything to add from your side?
No, thank you. As we're running off the time, I think it's better to have a Q&A session.
Sure. Okay. With that, then I'll open the floor. Are there any questions or points that you would like the panel to speak to in more detail? It appears that we're towards the end of the day in Baku. Perhaps that's the reason that folks aren't particularly chatty. If there are no questions, then I would say thank you very much to everyone for your time, for joining. It's been our pleasure to talk through the subjects. And as I mentioned earlier, and I'm sure I speak for all of the panel in saying this, we all welcome your direct correspondence on anything we've discussed here today. And also, as I mentioned earlier, we'll send around the materials from the presentation in case folks would like to look at those in more detail. If there's nothing further, then thank you again for your time and have a nice evening.
Have a nice evening.
Thank you, colleagues.